If you've ever found yourself thinking, maybe I should just wait until things settle down when the market gets volatile, this video is for you. Uncertain times have a way of making even the most disciplined investors second guess themselves. Headlines feel louder, market swings feel sharper, and suddenly, decisions that once felt easy feel overwhelming. Today, I want to walk you through the top investment mistakes people make during uncertain times, and more importantly, how to avoid them. Right up front, here's what we're going to cover. Mistake number one is panic selling. Mistake number two, waiting for clarity. And mistake number three, chasing headlines and trying to time the market. We'll also talk about what decades of market history, specifically the S&P 500, tell us about long-term returns both with and without dividends reinvested. And we'll wrap up with the single most effective way to build wealth despite all the chaos going on in the world, having a plan and sticking to it. Let's get started. Before we talk about mistakes, it's important to understand why uncertainty makes investing feel so hard. Uncertainty triggers fear, and fear pushes us towards action, even when doing nothing is actually the smarter move. This isn't a character flaw, it's human nature. Our brains are wired to protect us from danger. Thousands of years ago, uncertainty often meant real physical risk. Today, uncertainty shows up as market volatility, inflation headlines, political noise, or global events, but your brain reacts the same way. The problem is that good investing usually requires the opposite behavior. Instead of reacting quickly, long-term success often comes from patience, discipline, and consistency. The gap between how markets reward behavior and how humans are wired to behave is where most investment mistakes happen. And during uncertain times, those mistakes tend to show up in three very predictable ways. The first and most damaging investment mistake during uncertain times is panic selling. Panic selling happens when investors sell their investments in response to fear, usually after markets have already fallen. It feels like taking control, but in reality, it often locks in losses at exactly the wrong moment. Here's how it typically plays out. The market drops, news coverage becomes more dramatic, as if that's possible, portfolios decline, anxiety rises, and investors sell, not because their long-term plan changed, but because their emotions took over. The danger is that market recoveries are unpredictable and often swift. By selling during downturns, investors frequently miss the rebound, and those rebounds matter more than most people realize. This is where historical data becomes incredibly helpful. Over long periods of time, the S&P 500 has delivered average annual returns of roughly 7% without dividends reinvested and closer to 10% with dividends reinvested. That difference is enormous. Dividends reinvested allow investors to buy more shares during downturns when prices are lower, setting the stage for greater growth when markets recover. When you panic sell, you don't just miss price appreciation, you also miss dividends, compounding, and time in the market. And once those are gone, they can't be recovered. Panic selling turns temporary volatility into permanent damage. Now, panic selling feels logical in the moment because it promises relief. Selling reduces uncertainty right now, but investing isn't about minimizing short-term discomfort. It's about minimizing long-term regret. And historically, the market has rewarded those who can tolerate uncertainty better than those who try to escape it. Markets don't fall because something is comfortable, they fall because uncertainty exists. And ironically, that same uncertainty is what creates long-term opportunity. The investors who succeed are not the ones who avoid volatility, they're the ones who plan for it. The second major mistake investors make during uncertain times is waiting for clarity. Now, this one sounds reasonable. In fact, it sounds prudent. Why invest when things feel uncertain? Why not just wait until the picture is clear? The problem is that clarity never arrives when you want it to. There is always something to worry about: economic slowdowns, rising interest rates, elections, geopolitical conflict, Corporate earnings uncertainty. Markets don't wait for clarity, they move based on expectations, often well before things feel calm again. By the time clarity shows up in the headlines, prices have already adjusted. Waiting for clarity usually means waiting until markets have already recovered, and that delay comes at a cost. One of the most important truths in investing is this: some of the best market days occur very close to the worst ones. If you step out of the market during downturns and wait for uncertainty, you dramatically increase the odds that you'll miss those critical recovery days. And missing just a small number of strong market days can significantly reduce long-term returns. Remember those historical averages we talked about earlier? 7% annual returns without dividends reinvested? Around 10% with dividends reinvested? Those returns don't come in a straight line. They come from staying invested through uncomfortable periods when clarity is in short supply. Waiting for clarity often feels safe, but over time it quietly erodes wealth. The third big mistake during uncertain times is chasing headlines and trying to time the market. Financial media thrives on urgency. Every headline feels like breaking news. Every market move needs an explanation, and every explanation implies that action is required. But keep this in mind: headlines react to markets, not the other way around. When investors make decisions based on news cycles, they're almost always late. They buy after prices rise and sell after prices fall. This creates a pattern of consistently poor timing. Market timing requires being right twice: when to get out and when to get back in. And even professionals struggle to do that consistently. Long-term investors don't need to predict the future. They need to prepare for it. Let's bring this back to the data. The long-term performance of the S&P 500 with dividends reinvested shows that markets reward patience far more than prediction. Those roughly 10% annualized returns didn't come from guessing headlines correctly. They came from decades of economic growth, innovation, productivity, and compounding. Investors who chase headlines often feel busy and informed, but activity does not equal progress. In fact, excessive activity is often a sign of emotional decision-making rather than strategic planning. The market does not pay investors for reacting quickly. It rewards those who can remain consistent when others cannot. Here's the uncomfortable truth: the market is not the biggest risk to long-term investors. Behavior is. Panic selling, waiting for clarity, chasing headlines, these mistakes all have one thing in common: they pull investors away from their long-term plan during moments of stress. Successful investing is not about eliminating uncertainty. It's about building a strategy that includes it. This is where a real financial plan becomes invaluable. A good plan is not just a set of projections. It's a decision-making framework designed to guide behavior during difficult moments. A strong plan does three things especially well. First, it defines why you're investing. When your goals are clear, market volatility becomes background noise instead of a call to action. Second, it aligns your investments with your ability to tolerate volatility. If your portfolio keeps you up at night, it's not a market problem, it's a mismatch problem. And third, it sets expectations in advance. You already know markets will decline at times. You already know uncertainty will show up, and you've already decided how you'll respond. That's how you remove emotion from the equation. Let's talk about what you can actually do to avoid these mistakes during uncertain times. Step 1, revisit your plan when things are calm, not when markets are volatile. Planning during stress leads to emotional decisions. Planning ahead leads to discipline. Richard Thaler, an economics Nobel laureate, said, "Losing money feels twice as bad as making money feels good. Just know this feeling will find you one day." Step 2, make sure your portfolio reflects your real volatility tolerance, not an optimistic one. The right portfolio is the one you can stick with. Step 3, reduce noise. Checking your portfolio daily or consuming constant financial news increases anxiety without improving results. Even as a financial advisor, there are days I cannot tell you how the market performed. It's just not relevant to a decades-long financial plan. And step 4, work with a fiduciary advisor who helps you stay focused on what matters most. your goals, not the headlines. Uncertain times are inevitable. Market volatility is normal. Headlines will always find a way to sound alarming. But the top investment mistakes during uncertain times are surprisingly consistent. Panic selling, waiting for clarity, and chasing headlines. History shows us that long-term investors who stay disciplined, who remain invested, reinvest dividends, and follow a thoughtful plan are far more likely to build lasting wealth. The S&P 500's long-term returns, especially when dividends are reinvested, are a powerful reminder that patience and consistency matter far more than prediction and reaction. Financial freedom for personal significance doesn't come from avoiding uncertainty. It comes from building a plan that works through it and sticking with that plan regardless of the chaos happening around you. I'm Josh Duncan, partner at F5 Financial Planning. If you would like to learn more about how we help our clients achieve financial freedom for personal significance, please visit our website at www.f5fp.com. Thanks for watching, and I'll see you next time.